independent demand, inventory management. Types of inventory. Raw materials. Purchased item or extracted materials transformed into component or a product. Components. Parts of sub-assemblies used in a final product. Work in a process or WIP. Item in a process throughout the plant. Financial goods. Products sold to customers. Distribution inventory. Finished goods in the distribution system. How companies use their inventory. Anticipation inventory or a seasonal inventory is built in anticipation of a future demand, planned promotional programs, seasonal fluctuations, plant shutdowns, and vacation companies build anticipation inventory to maintain level production throughout the year. For example, the toy industry build toys throughout the years in anticipation of high seasonal sale in December. Number 2, fluctuation inventory or safety stock is carried as a cushion to protect against possible demand variation, just in case of unexpected demand. For example, you might keep extra food in the freezer just in case unexpected company drops in. Fluctuation inventory or a safety stock is also called buffer stock of reverse stock. Number 3, lot size inventory or cycle stock. Result when a company buys a product more than is immediately needed. The extra units of a lot size inventory are carried in inventory and depleted to a customer order. Number 4, transportation or a pipeline inventory is an transit between the manufacturing plant and the distribution warehouse. Transportation inventory are the items that are not available for satisfying customer demand until they reach distribution warehouse. So the company needed to decide between using slower, inexpensive transportation or a faster, more expensive transportation. To calculate the average amount of inventory in transit, we use the formula. ATI equal to TD over 365, where ATI average of transportation inventory in units and D for the transit time calculated in days, and D equals to annual demand and it's in units. How companies use their inventory. Number 5, speculative or hedge inventory is built up to protect against some future events such as a strike, your supplier, a price increase, or the scarcity of a product that may be not happen. A company typically builds speculative inventory to ensure continuous supply of necessary items. Number 6, maintenance, repair, and operating or MRO. Inventory includes maintenance supplies, spare parts, lubricants, cleaning compounds, and daily operating supply, such as pens, pencil, and notepads. How well they are handling their inventory investment. Customer service. What is a customer service? Customer service is a company ability to satisfy the need of its customer. When we talk about customer service in inventory management, we mean whether or not the product is available for the customer when the customer was it. In his sense, customer service measure the effectiveness of the company inventory management. Customer can be either external or internal. Any entity in this supply chain considered as a customer. Percentage of orders shipped on schedule is a good measure for finished good customer service, such as your kayaking equipment company. If all your orders customer have similar value and late deliveries are not excessively late. For different kind of a company, such one of the design computer networks. Some computer have much greater value. Obviously, this method does not adequately capture the value of the customer's order. Recognize not all orders are equal, but fail to take into account the dollar value of orders. This measure needs more information, the number line items instead of number of orders than the previous measure. Therefore, this measure is more expensive to use and most appropriate for finished good inventory. Recognizes the differences in order terms of both line items and dollar value instead of measuring line items to determine the customer service level. A company totals the value of the orders. Apply to internal customer service. This is absolute measure of the manufacturing or service time lost because material or parts are not available. To the work phase. Absolute measure makes sense when a company has historical data to use in a comparison. Cost-efficient operation. Companies can achieve cost-efficient operation by using inventory in the following ways. First, companies use work in process of WIP, inventory buffer operation supposed over the Hewlett Packard or HP printed circuit board or PCB. Manufacturing facilities run into to move operation in a sequence different rates of output in the case buffer inventories. Build up between the workstation to ensure the edge of operation efficiently. Setup cost. Costs such as scrap cost, calibration cost, and downtime cost associated with the preparing equipment for the next product being produced.
Good day everyone. My name is Christopher Tamaneng and my topic is minimum inventory investment and relevant inventory costs. A company can measure its minimum inventory investment by its inventory turnover, that is, by the level of customer demand satisfied by the supply on hand. We calculate the inventory turnover measure as inventory turnover. Annual cost of goods sold. Example. So if your total sales are $40,000 and the average inventory value is $10,000, your turnover would be $40,000 divided by $10,000 equals 4. Weeks of supply. Weeks of supply is calculated by dividing the average on hand inventory by the average weekly demand. Weeks of supply equals average inventory on hand dollar. Average weekly usage in dollar. Inventory objectives, customer service, percentage of orders shipped on schedule, percentage of line shipped on schedule, percentage of dollar volume shipped on schedule. Idle time due to component and material shortage. Cost efficient operation. Using buffer stock to assure smooth production flow, maintaining level workforce allowing longer production runs, taking advantage of quantity discounts. Minimum inventory investment. Inventory turnover, weeks of supply, days of supply. Relevant inventory cost. Inventory management policies have cost implications. Decision about how much inventory to hold affect item, cost, holding cost, ordering cost, and stock out. Item cost. Item cost includes price paid for the item plus other direct costs associated with the purchase. In order definition, the item cost is the charging cost by a vendor or supplier for each individual item. This is the cost that a retailer would pay per item when ordering a specific product. Holding cost includes the variable expenses incurred by the payment related to the volume of inventory hold. Holding cost refers to the amount of money that needs to be paid in order to store unsold inventory. Capital cost. Capital cost, the higher of the cost of capital or the opportunity cost of the company. Capital cost is the money used to build, run, or flow a business. It also refers to the net worth or book value of stock business. Storage costs include the variable expenses for space, workers, and equipment related to the volume of inventory held. Risk costs. Risk costs include obsolescence, damage, or destruction, theft, insurance, and taxes associated with the volume of inventory held. ABC inventory classification. All items in a company inventory are not equal and do not need the same level of control. Fortunately, we can apply Pareto's law. Determine the level of control needed for individual items. Pareto law implies that roughly 10 to 20% of a company inventory items account for approximately 60 to 80% of its inventory cost. ABC inventory classification. Many retailers categorize their inventory using the ABC classification method, which is based on the Pareto principle, which states that 80% of your results come from the 20% of action. When applied to the context of inventory, it means that 80% of revenues are generated by 20% of your product. With ABC, inventory is classified according to the value of the product unit. For the most retailers, the classification structures like this. Group A, inventory. The 20% of is cost that contribute to 80% of revenue. Group B, inventory. The 30% of is cost that contribute to 15% of revenue. Group C, inventory. The 50% of the SKUs that contribute to 5% of revenue. Inventory control using ABC classifications. Continuous review system updates inventory balance after each transaction. Periodic review system requires regular periodic reviews of the hand quantity to determine the size of the replenishment order. 2-bin system. 1 bin with enough stock to satisfy them, and during replenishment time is kept in the storeroom. The order is placed on the manufacturing floor. Lead time. Time from order placement to order receipt.
Vendor Managed Inventory (BMI) requires the vendor to maintain an inventory of certain items of the customer facility. The supplier still owns the inventory until the customer actually withdraws it for use at the time. The customer pays for the item. The customer does not have to order any of the inventory, as the supplier is responsible for maintaining an adequate supplies. Companies use this approach most frequently with lower level C items that have a relatively standard design. Determining order quantities. Stock Keeping Unit (SKU), an item, a particular geographic location. Lot per lot, the company orders exactly what is needed. Fixed order quantities, specify the number of units to order whenever an order in place. Minimax system, place a replenishment order when the on-hand inventory falls below the predetermined minimum level, an order in place to bring the inventory back up the maximum inventory level. Economic Order Quantity (EOQ). The Economic Order Quantity model (EOQ) has been around since the early 1990s and remains useful for determining order quantities. EOQ is a continuous review system used to keep track of the inventory on hand each time stock is added or withdrawn. In the withdrawal, reduce the inventory level to the reorder point or below. You make a replenishment order. Economic Product Quantity (EPQ) model. The cycle being when we start making the product. Each day we use some of what we make to satisfy immediately demand. We put the remainder inventory. We make a product we have completed Q unit at the point the inventory has reached in a maximal level point on what satisfy demand from the on-hand inventory, depleting in daily. When we order point, we order another batch. Our company start producing the new batch just as we out of the current inventory. For effective inventory, use the inventory record must accurately reflect the qualities of materials available. Inaccurate inventory records can result in lost sale, finished good not available at time of sale, disrupted operation, not enough of a component or raw materials to complete a job, poor customer service, late deliveries to customer, low productivity, additional setup to complete a job, poor materials planning. The inventory records are critical in determining MRP quantities and excessive expediting, trying to obtain necessary item in less than normal lead time. Periodic counting. Satisfy auditor the inventory records accurately reflect the volume of the inventory on hand. For materials planner, the physical inventory is an opportunity to correct error. The four step in taking a physical inventory are: 1. Count the quantity of the item and record the count on a ticket attached the item. 2. Verify by recounting. 3. After verification, collect the tickets. 4. Reconcile inventory records with actual count for major. This represents in vintage. Further, For minor discrepancy, adjust the inventory records. Cycle counting is a method of counting inventory throughout the year. This is a series of mini-physical inventories done daily for some specified item. The frequency of counting a particular item depends on the importance and value of the items. Typically, items are counted most frequently. The advantage of cycle counting are timely detection of correction of inventory records problem, elimination of lost product time since the company does not need to shut down operation, the use of employees dedicated to cycle counting, vendor managed inventory (BMI) requires the vendor to maintain an inventory of certain items at the customer facility. The suppliers still own the inventory until the customer actually withdraw it for use at the time.
Perpetual inventory record provides an up-to-the-date inventory balance quality discount model. Modeling the EOQ process the consider case where a quality discount are available. Order cycle service level. The probability that demand during lead time will not extend on had inventory. Target inventory level. Used in the determining order quality in the periodic review system. Target inventory less on hand inventory equals order quality. Single period model. 26 signs of use with products that are highly repressible. Inventory management. Inventory management provides the materials of supplies needed to support actual manufacturing a service operation. A product cannot be built unless the required materials is available. Inventory management. Across the organization, accounting is the connected because use the implication of inventory as the holding cost included the capital needed to event in inventory. The project cash flow budget accounting in the connected which of types of inventory. Marketing and connected because stocking decision after the level of cost service provided. Information system is the involved because a system of track on control in interest of needed, especially when prepared inventory costs are used 27.